But first, I'd like to welcome our keynote speaker, Sir Paul Tucker. I think in this setting, I reckon he probably needs no introduction. Suffice to say, he's a former Deputy Governor of the Bank of England, and I dare say from my own point of view, commands the kind of respect that's normally attached to governors. He left the bank in 2013 and since then has been a research fellow at the Harvard Kennedy School. Sir Paul is also the author of Unelected Power, an important book on how to reconcile independence with accountability at central banks. It's something we're talking a lot about at OMFIF. It comes up again and again in our private roundtables. And perhaps a theme we'll touch on today briefly with Paul, who's also writing another book at the moment on currencies, the global economic system and geopolitics. So welcome, Paul. It's very, very good to have you with us.
Inviting me.
Pleasure. You thought carefully about the role of central banks and what their optimal structure and nature might be. In that regard, the digital currency discussion goes quite quickly from the technical to absolutely fundamental and then back again, as I've mentioned. So let's explore some first principles there first. Central banks are looking at CBDC for a variety of reasons, among them the possibility that money, cash is being squeezed out of use by the rise of contactless M1 on the one hand, and new versions of private money such as stable coins, cryptocurrencies on the other. Do you think it's important that central banks should continue to provide a retail cash product, or should we let innovation have its way, but improve the oversight and regulation of private versions of money? What do you think, Paul?
Both, definitely both. I think it's essential that central banks, on behalf of the state, ensure that cash remains available to anyone that really needs to use it. I mean, it would be an intolerable state of affairs if people in an obscure part of the territory, but an important part of a territory for them, didn't have access to digital payments or just preferred to use cash for whatever reason. So this ultimately is a question for government. This is like private sector has no incentive to ensure that everyone has access to a service, which is why we have laws saying that the postal service and the telecom service must be available even in remote districts. But people not having a means of payment would be much more severe than rural areas in Britain, or too many rural areas in Britain, not having a good broadband connection. But that's not the only reason. The ultimate backup to digital is analog, and I suggest it would be reckless to go into a world where we thought that everything could be digital, given that there is a non-negligible chance of conflict between the great superpowers. And if there is great conflict between the superpowers, we have no idea what cyber attacks would do. I think we've seen barely the tip of the iceberg of what could happen, frankly, in a war, if you like. If the internet was switched off, or if a country's digital payment system was switched off, that would be very serious. And let me just add one thing, not for me to go too far into this. This was a thought that was entertained by the top of the Bank of England when I was there, and it could only have become more serious in the meantime. But both, because of course innovation should be allowed. I think it was utterly stupid to talk about sandpits, which connote something childlike rather than something serious. And I don't think regulators should try to use silly language like that. But of course, innovation should be allowed. It's important, though, to distinguish, and this will be a theme in my remarks, to distinguish between private money or private safe assets and the tubes, whatever they are, through which those safe assets are transferred, and other types of innovation. We need to make a very sharp distinction, to the extent we can, between things where the public and investors treat something as safe and other stuff.
Okay, and we'll come back to that specifically with CBDC in a moment. I think maybe there are different standards of safety and security that would need to apply to money versus securities, for example. You've talked a lot about and thought a lot about how central banks should be. They're quite complicated to structure. They do lots of different things. And the CBDC discussion reminds us to ask that. So I wanted to ask you briefly to reflect on that. Central banks have a variety of remits alongside targeting inflation, perhaps their most important task. some supervised banks. In the Bank of England's case, that was taken away from it as the price for independence. Perhaps the ECB is a bank regulator. In some cases, there are debt management operations. Bank of England used to do that, for example. Others gave birth to sovereign wealth funds, and many have been asked to fix climate change, which has prompted a debate or helped fix it. What are central banks for, Paul, as we wonder about CBDC and the mandate to provide cash to the public as a public good?
They are for monetary system stability and an independent central bank insulated from day-to-day politics. Not all central banks are independent, but those that are should stick to that. And they should stick to that because the more things they do, the less easy it is to harness their leaders to their core mandate. I mean, if a central bank notches up great achievements on climate change or inequality, but there's a financial crisis or minor financial crisis or inflation gets out of control, the leaders of the institution, their prestige may escape intact because of their broader contribution to society. But actually, that would be a failure for society as a whole because they wouldn't have delivered on the thing that only they can do. And this monetary system stability mandate has two components. Low inflation, which means that the price of central bank money, public money, is maintained in terms of goods and services, but also system stability in the private monetary system, which means that private money can be converted into central bank money at an exchange rate of unity. But notice I haven't said banking. The private monetary system happens for the last 200 years mainly to have been banking, but it doesn't mean that it can only be banking. My formulation can certainly cater for innovation and has in degree in the past and will need to. And the ingredient, I think, in the private monetary system, whatever counts as it, is what is treated as safe. And I think the central bank community internationally would have made much greater progress over the past 10 years on shadow banking and actually on innovations, had they thought in terms of what are the public and investors and traders treating as safe and what's the other stuff. I for what it's worth, and to do a bit of advertising, there's now a blog site called Macroprudential Matters, run by some former central bank researchers, and I contributed a blog on this issue to them a few weeks ago. But however many hundred people are watching, I think Macroprudential Matters is something that people should get hold of and subscribe to.
On the matter of safety, of course, the discussion about CBDC includes often the idea that perhaps stable coins might be regulated like banks, so that they could hold reserves with a central bank, and they would almost, I suppose, become narrow banks, or even ultimately actually banks if they ever were to disperse credit. Would you be open to that, presumably, Paul?
Yeah. Broad terms. I mean, the kind of framework I have is one where, if you like, there's a spectrum of private monetary institutions, and some might be banks as we know them now. Some might be investment banks. There's absolutely no doubt in my mind that the investment banks were truly monetary institutions before the 2007 crisis. Certain types of money market fund, stable coins. It doesn't mean they all need to be subject to precisely the same regime. But the defining characteristic is people are treating this as safe. And it can only ultimately be made safe if the central bank is standing behind it.
Yeah. In our sessions about central banks, we hear just off CBDC briefly, but I think we'd like to hear your views on this. In our other sessions at ONFIF, we talk a lot about fiscal dominance, not least because of the special circumstances around weighting against the damage done by COVID to the economy. So there is a huge amount of fiscal and monetary work all taking place at the same time, and indeed overlapping, as you know. And there are concerns that the related QE programs are undermining, or potentially could undermine, independence, or more importantly, perhaps the perception of independence, or generate conflicts of interest, or even lead to an overreach of the responsibilities of central banks. I know that you thought about this. The German Constitutional Court suggested, for example, the ECB's first QE scheme already did this. And you raised broadly concerns about how well the purpose of QE was communicated at the Lord Select Committee you spoke to a few months ago. Before we go back to CBDC, how do you think central banks should preserve their inflation beating independence on the one hand and retain what you describe in your book as legitimacy on the other?
Well, I think there's a distinction between what they can't do and what they can do. So if you look at the states at the moment, I have little doubt that the path of UK monetary policy over the past year has been affected by job prospects. And that's not anyone's fault. That's because the term of the chair is 4 years, which is too short. Had it been 8 years, I think we would have seen tapering earlier. And this isn't to criticize people I admire. It's that the design of the regime needs to shape people's incentives. But there are things central banks can do. Let me just rattle off some. It was a mistake to describe what was essentially a market maker of last resort operation in the spring of 2020 as quantitative easing. Because had it been properly described, it could have been reversed more easily, and governments would have then financed themselves in the bond markets, locking in very low cost long-term funding. And you can see the problem here by the way that finance ministers around the world have started expressing concern about the effect on the public finances of interest rates and inflation. And we haven't got time for me to unpack that, but this is a very strange formulation that I've never heard before. Because normally if interest rates go up, inflation isn't going to go up, and your debt servicing costs aren't going to go up because that will keep long bond yields down. But if you've done a debt swap, which is what QE is, then you do become concerned about that. I think this is a problem. And something else you shouldn't do, don't describe forward guidance as forward guidance if actually you're not making a promise. It's describing your reaction function is quite different.
Yeah.
It's different because you don't know what's going to happen in the world. So they should just drop this expression forward guidance, except when they're truly stuck at the zero lower bound and need to do the special thing that Ben Bernanke tried to do. But the other thing they can do, and this works on the monetary policy side, not so well on the financial stability side, they need to craft for themselves and help treasuries to craft for them objectives that are straightforward and can be monitored. And we're seeing that on inflation. I mean, the public debate about inflation is, giving them a degree of heat. And maybe their judgments will all turn out to be right in all of the big centers. That would be a good thing. But that there is a debate is because they've got targets of 2% and inflation is somewhere between 3 and 5, depending on what country you're in. And people are saying, what on earth's going on? What's your explanation? No such thing on the financial stability side. I'm not picking on the UK, but we have no idea what the Financial Policy Committee or Prudential Regulatory Authority are achieving in terms of resilience. I'm not proud of that because I'm the architect of that system. And I had hoped that it would be more transparent, and I had hoped that there would be more votes. So let me just finish this answer by saying I think votes are terribly helpful. When there are votes, a minority against a majority, that helps to focus public debate. It helps to focus parliamentary or congressional oversight. And I think we need to see votes on in the financial stability mandates as well. Disagreement is fine because it highlights what to the world, to people like you and OMFIF and others, what the big issues are behind closed doors. In other words, the doors are opened on what matters.
Right.
So I think that they can do more to help themselves by the way they frame monetary policy, and on the financial stability side by moving towards voting and developing an objective for resilience. And frankly, in the UK, the Treasury apparently is proposing to give competitiveness to the regulatory side. Well, this is what got us into trouble before.
Just on the bank supervision point related to financial stability, the ECB, the most important bank in the geography we're talking about, is an important bank supervisor. You've thought a lot about that and were involved in the structures in the UK. As I say, partly the structure was the price to pay for independence. What do you think the optimal way to arrange that is, as financial stability crops up again and again also in the CBDC discussion? And it's one of the reasons why retail CBDC is going slowly in Europe, because the ECB is worried about disrupting the commercial banking sector too much, which has been wrestling with low or negative interest rates. So what, just very briefly, what do you think the optimal structure should be when we said that central banks maybe are doing too much and aren't accountable with respect to overseeing banking system?
The structure of the central banks or the structure of the private banking system?
No, the oversight capacity of the central banks on the banking system.
I think the bank should have a monetary policy committee and then a financial stability committee. And I prefer, which is one reason the UK has this, I prefer to separate, if you macro financial stability task into one committee and the micro task, where issues of due process are very significant, into another committee. But, and that's the structure the UK's got, and I still think it's the best. And Vitor Constancio, who used to be the number 2 at the ECB, thought that the UK was a model. But I think that the UK structure that my generation, Mervyn and I, and people in the Treasury then bequeathed, is not one that places the FPC or the PRA under a sufficient resilience standard. And actually, for the ECB, if I were Andrea Enria and or Christine Lagarde, I would want to leapfrog the UK by developing an objective to which we, the ECB, could be held accountable. The great breakthrough in monetary policy 25, 30 years ago was to try and box ourselves in by having an objective and a transparency where we would be constrained to try to do the right thing, and people could see whether we were really trying and see whether we were achieving. And that was, and I think people spent a lot more time in the 80s and 90s thinking about the design of monetary policy regimes than they have over the past 10 years of thinking about the design of stability regimes. People tend to get lost in the detail rather than thinking about, hold on, what we're trying to do is design a governmental agency that will do what we want it to do.
Just to touch, there's a lot to explore on that theme. Perhaps we can come back to it another time. It's important. I want to touch briefly on the geopolitical output of this CBDC discussion, which comes up a lot in our roundtables. And I know that you're writing about it at the moment. We found our own research, both an institutional and retail reluctance for CBDC in the US and Germany, for example. So our own research that we've done with the money technology company G&D. Do you think it would ultimately impact the reserve status of the dollar, which I know some people are worried about, or to some extent the euro, if the Fed or the ECB were to take their time on CBDC? The ECB is thinking about it for 5 years, very complicated, but China's moved ahead for its own reasons, partly to disrupt their own private sector payments duopoly. Do you think, based on your essential thesis about the benefits of the dollar system in the world, that obliged economies are obliged to, developed economies are obliged to press on with CBDC, whether their populations want them or not, do you think?
I think they're wise to prepare for it. I think they should put themselves in a position where there are no technical or policy obstacles to introducing one if that turns out to be the prudent thing to do. They shouldn't say, well, we're not going to do this because it's not wanted, and then in 2 or 3 years' time think, oh my God, we've got that wrong. We're going to have to do it after all. The stake is particularly high for the dollar. Too few people in finance, in the monetary sphere, make the connection between the role of the dollar in the world and the role of the United States in keeping the sea lanes open and defending us. Frankly, in Europe, including my own country and France, where we both are able to project some power, ultimately our defense depends on the United States. And I'm not alone in thinking that their ability to do that depends partly upon the advantages that the dollar gives them, including the resilience it gives their economy during crises. I think the PRC may well think they're in a win-win situation here. that either they proceed on their own or ahead of the other two major currency blocks, the dollar block and the euro block, and that may give them an advantage. Or alternatively, the Western world, Western in quotes, also develops digital currencies, but in the process, Western economies become more like a state-led economy through the role of the central bank in the monetary system and credit allocation. And I think actually, I think the PRC are playing this very skillfully. I think they probably are in a win-win situation, subject to Western monetary authorities answering the really big architectural question about digital money.
And well, the concerns that you've implicitly raised just now are those that we get in the retail surveys that we do about the role of the state in private information about small transactions and so forth. But we'll come back to that. We haven't got much time, but I'm very keen to ask you this last point, Paul. When we spoke to the Bank of England about their CBDC reviews taking place still at the moment with the Treasury, we talked to John Cunliffe, your former colleague. They seem pretty relaxed in principle about a degree of disruption to the commercial banking sector, and we know that the ECB is less sanguine about that, specifically keen to avoid it. The PBOC's pilot we've just been talking about is distributed through its commercial banks and other payment providers. The DLT revolutionaries in our session suggest banks are inefficient rent seekers who can be taken out of the equation altogether. There are all sorts of reasons why they're wrong, but we know why they make their point. Though they forget about credit creation and fractional reserve banking and so on, which the economy is dependent upon. Do you see much of a change for banks' role in the economy and the creation and transmission of money over the next generation?
So I think this is the big question. So the first thing to say is that those people in the private sector that accuse the commercial banking system of being rent seekers, it's important to remember that were they to be the dominant institutions, they would be rent seekers themselves.
Exactly.
This isn't something about virtue. It's something about where antitrust law and policy meets monetary system policy. So don't accept, you should just brush off, frankly, accusations of that kind which are clothed in virtue. Secondly, I would say is that to the extent that UK and Euro area authorities strike a different tone, that may be different presentational strategies rather than different analysis of the substance. The key thing here is this. There is a great architectural question which I think the authorities need to answer in terms of this question. So for over 250 years, since we moved through quill pens and all the other technology that's brought us to today, the architecture of the monetary system has been the same. And it's one where we have public money and private money that's issued by banks mainly at the moment. And that keeps the state out of credit allocation. When I was running the Bank of England's balance sheet, and when Eddie George ran the Bank of England's balance sheet before me, they didn't sit around thinking, who shall we lend to in the real economy or which region today? But by making that choice, you end up with a financial stability problem because the private part of the monetary system, banking as it's been, is inherently unstable. An alternative approach, which some people on the left prefer, you see this with the person who's the candidate to be head of the OCC in the States, is that members of the public and small firms should have accounts with the central bank, and that digital money is going to enable that. And the alternative model is one where we get rid of the financial stability problem, but the central bank becomes the state credit bank and is involved in the allocation of credit in the economy. And what officials are currently saying is, around the world, including in the PRC, is no, we will limit the amount of digital currency that people can hold. I think China has a limit of equivalent to $3,000 or something like that. Maybe I'm wrong. But The test of this is, well, what happens in a crisis? What happens when there's a major run on the banks? Do you lift the limit? Or when people around the country, if they've got accounts with the central bank, when they reach zero, do you then provide overdraft facilities for them? And as soon as you do that, you have transformed not only the nature of the monetary system, but the nature of the economy. And there may be a democratic will to do that, but it's something you should do only through democratic will, not by accident in the midst of a crisis.
Well, I think that
the question isn't about banks. It's about what is the role of the private part of the monetary system. And I can imagine a world where the things that are now called banks become marginalized over, I don't know, some period, but there are other private monetary institutions.
Yep.
And that, no one should be opposed to that in principle. The big question is, does one want credit to be allocated in the private sector with a welfare insurance safety net provided by the fiscal authority, or does one want my successors' to be sitting at their desk saying, actually, I need to lend more to the north to help leveling up, or I need to lend more to the coal industry to keep it in existence, or less to the coal industry to take it out of existence. And I think I think this is the really big question, and it's one I would like to see politicians answer definitively. Do we want a state credit bank, or do we want credit allocated mainly by the private sector? And if they answer that, well, we want it mainly allocated in the private sector, then the question is, how do you maintain that and introduce digital currency at the same time? And this is not about defending the incumbency of banks, but nor is it about setting out to undermine the incumbency of banks.
I think that's right. And it's why it's so complicated. Indeed, why the ECB is spending 5 years thinking about it. It's very, very difficult to solve. But Paul,
well, these big questions don't take 5 years. They take the right people having a handful of meetings over a few months. They do not take 5 years.
Okay. Well, perhaps hear your plea. But Paul, it was a very brief tour of major issues today. But thank you very much for that. It was an extremely useful way to start this discussion today. So thank you very much indeed for being with us.
Well, thanks for having me on, and I hope you have a great day.
Thank you very much. Thank you.
Bye-bye.
Bye.